Hey, Jed Barker here, Best Life Mortgage. I make these videos to help you understand the loan process better so you can make better informed decisions while buying a primary home or an investment property. Today, what I'm going to talk about is investment properties and purchasing investment properties while using what's called a DSCR loan. It's really, in my mind, an awesome loan product for investors who want to buy properties. Multiple properties. Maybe it's just one property, but maybe get into the business of buying multiple loans and not having to qualify for those based off of your standard debt to income ratios like you would on a primary home or just a conforming conventional loan. So let's get into it. Let's talk about debt service coverage ratio loans. First off, DSCR, when you hear that, it's typically, maybe formally applied to commercial lending, because when a lot of times when, investors are buying commercial buildings, apartment buildings, malls and stuff like that, they'd be using, commercial lending for that, not, residential lending, 1 to 4 unit, conforming conventional loans. And so it's more of a commercial product. What's really cool is in the, recent years, I don't know exactly how many, but in the recent years, last decade or so, commercial loans have been brought over to the residential world and now used quite a bit to buy residential investment properties, 1 to 4 units, 5 to 8 units, or 8 unit plus. And they think about DSCR. What does it stand for? Well, I've said that it's a debt service coverage ratio loan. And what the big difference is here to understand is how the lender qualifies you as an investor on this loan product, this debt service coverage ratio loan, as opposed to the difference between how you would qualify on a conforming investment conventional loan, with the ability to repay the loan based on your own personal income and your own personal debt load, as opposed to a commercial type of loan like the DSCR. You're not going to be qualifying for it off your personal income and your personal debt load. And so it's going to be different. So let's actually break into that. I got a few notes here I'm going to look at. I've done a lot of DSCR loans in the past. We do a lot of them now, but I have some notes to look at to sort of keep me on track of the most important points of this. And so as I look down here, first thing I want to talk about is what they call a DSCR ratio. So when you qualify for a DSCR loan, what you're in fact doing is you're not qualifying at all based on your personal employment. So there's no W-2s collected, no tax returns typically collected, pay stubs, stuff like that, because your personal income, it's out of the equation. That's one of the beauties and benefits of a debt service coverage loan, is that you're not using your income to qualify. And so how do you qualify then for a DSCR loan? If you're not using your income, whose income are you using? Because there still has to be an ability to repay the debt, right? What you're doing is you're using the home's ability to repay the debt, meaning they're looking at the ratio between what the home has the potential to collect in rental income, and what the mortgage payment's going to be, and what is the ratio between the rental payment and the mortgage payment. And when we talk about mortgage payment in this factor, when the lender looks at that, they're not just looking at the principal and interest; they're looking at the full mortgage sort of cost of ownership, which would be your principal, interest, your taxes, and insurance. And in the lending world, they call that the PITI, right? The PITI. PITI, you'll hear that name, PITI. That's sort of funny, but it is the principal, interest, tax, and insurance. That's what they're comparing the ratio to, is the rental schedule. Typically, it's a rental schedule because the home's not rented yet, so they're using the market rent for it, and that's collected through an appraiser. And the appraiser say, hey, this home would potentially market and rent out for this much on a 12-month lease term. And then they're comparing that. So let's do this for a minute. Let's imagine the rent on the home will rent out for $2,000 a month. That's what the appraiser says. This is $2,000 a month on a long-term 12-month rental schedule. And then the loan actually comes out to $2,000 a month when you factor in PITI or your PITI. That's a 1-to-1 ratio. And that is a actually good ratio for this type of loan. That will be what a lender will look at as very positive, a positive ratio that will get you into better interest rates if you're at a 1-to-1 ratio than it would be if you were less than 1-to-1. And so that's one of the qualifiers there. What if it was like $2,000 a month for the rent, but the home only brought in $1,700 a month? That's a less than 1-to-1 ratio. And so that's not going to be looked at as favorably, because that means that the income produced by the property will not be paying the PITI in the property. And so it won't be cash flowing, right? And so that will be looked at more negatively. Now, can you get qualified with a negative inverse ratio? You actually can. You're just going to have a higher interest rates, maybe less flexibility on LTV, and that's loan to value. That's your down payment, stuff like that. So we're looking for is homes that make more sense. And for you as an investor, you might want that as well. Homes that make more sense that would potentially cash flow, right? A lot of times you want your rental home to cash flow, not just to like be spending extra money every month more than what you're bringing in, right? That's sort of a negative when it comes to investment properties and in business. You're looking to get properties that will bring you in more than you're spending. More than it costs. So that's what the lender's looking for in that as well. So is that the only factor that the lender will look at when it comes to DSCR? No, it's not. The ratio is important and it does need to match up, but they're also going to look at your personal credit score. The higher the credit score, the more likely you are to qualify for a better loan terms, meaning lower interest rates, more flexibility on LTV, stuff like that. So credit score is important. It's going to be one of your factors. They're going to look at the DSCR ratio. And what is the next one? And possibly the last one for this type would be your reserves, which we're going to say your cash, right? How much money do you have? Typically, the minimum down payment on a single family debt service ratio loan is going to be 20%. Okay. It will go higher than that if you're going to do multifamily. Could be 25% or more, depending on how many units you're purchasing, stuff like that. But the reserves are important. So reserves essentially are how much money do you have in the bank left over that's yours after you buy the property, after you pay for your down payment, and after you pay for closing costs. What do you have left over? Are you dead broke at that point and you're like no money left? And if you had anything go wrong with the property, you might not be able to pay your mortgage next month, right? Like they don't want that, right? They want you to set you up for success. So you got to have some money left over. So after your 20% down payment, maybe your 2 to 4% closing costs, how much money do you have left over? So most lenders are going to be looking at least 6 months of reserves, and reserves are that mortgage payment times 1 is 1 month reserve times 2 months reserve times 3 months reserve. You get the point. 6 months reserves. Some lenders will be looking at 12 months reserves. Now, how can this become less of a necessity? Could become less of a necessity if you get more experience. So the lender may ask, how many homes have you purchased as an investment property in the last 12 months? Has it been 0? Has it been 2, 3? And there you get, usually that question isn't 12 months. Usually it's in the last 3 years. Okay. And so more properties, maybe you'll have more flexible terms. What I'm going to do now is I'm actually going to show you a rate sheet. This isn't my company's rate sheet. This is just a rate sheet today with one lender who does DSCR loans. I'm a mortgage broker, and so I have access to lots of different wholesale lenders that will do DSCR loans. And I'm just going to look at one rate sheet that I have. This is by no means the rate sheet that we would use if we were to do a loan today, but it is one, and it's easy to look at. So I'm going to make this little thing smaller. I want to pop over to this rate sheet. Now, you might be looking at this. I'm going to blow it up a little bit. Let's see here. There it goes. Let's see. Actually, I'm going to download this rate sheet into a PDF format. I think that'll be easier way to look at it. And I think you'll be able to see it. There it goes. All right, cool. So here we go. This is a rate sheet. Now, the cool thing is this is going to look like a ton of information, right? Like, what is this? And you might need a lot more education and understanding to actually walk through this rate sheet. But this is sort of cool because it shows you a few things, right? So the top of it, where my cursor is, look at all these different buckets, 750, 725, 700, 600. These are credit ratings, right? And so as you go through the credit rating, you'll notice directly below that, these are interest rates. Look at that. So different credit, different interest rates. Sort of a great thing to understand, right? And then on the very far left side, these are LTVs, right? And so let's take a look at an example right here. It says LTV. Now on the DSCR loan, you can't go over 80%, so we won't jump into this 90% one, but let's look at this 80% LTV. It says with 750, okay, credit score at 80%, your starting rate is 8.125%, right? So if you look at that, you just draw that line there between how I'm doing with that mouse cursor. And as you go down, your rate goes higher as you get a lower interest rate, as you get a lower interest rate with lower credit, or a higher interest rate with lower credit, right? So if you go there down to you get a break on interest rate if you go bigger down payment. So that's sort of cool too, right? Like let's look at this one, 70% LTV. Starting rate for 750 FICO, 7.875, as opposed to 8.125 if you went to 80. So that's a great little thing to understand. There's also other things when it comes to DSCR loans that you might want to understand, because there's also what's called pricing adjustments. These are adjustments to interest rate based off your preferences, or maybe based off what you're doing. So if you look at some of these adjustments, I'm going to jump all the way down to this one, interest only. That's an adjustment. It says they can give you a 10-year interest only loan, but they're going to add a half a point or 0.5 or a 0.5% interest increase. So you're going to pay higher interest to get an interest only loan. Sort of interesting there, right? If you go down further, there's you made non-permanent resident, you might have an interest rate adjustment on that. Sort of interesting. Short-term rental adjustment, so all kinds of stuff like that, right? So these are different adjustments to your interest. There's one other thing, a couple other things I wanted to talk about with DSCR loans. So here's one of them. When you do most DSCR loans, I'm going to get rid of this rate sheet. I thought that was sort of interesting for you to see, but I'm going to ditch it for a minute here and go back over here. Okay, so I'm going to blow this back up again. All right, cool. So here's another thing. With most non-conforming loans, like non-QM is what they call them, or DSCR loans as well, you may have what's called a prepayment penalty, meaning the lender is expecting you to hold on to that loan for a certain amount of time. And if you don't, they're going to charge for it as a closing cost when you sell the loan or refinance that loan. And so how that works with most DSCR loans, you might have a 3-year prepayment penalty. And in the first year, if you close the loan, you might pay a 3% prepayment penalty. In the second year, you might pay a 2% prepayment penalty. In the third year, you might pay a 1% prepayment penalty. Some of them are going to charge you 3% no matter what. 3% 1 year, 2 years, 2 years, 1 year, right? Or you might even have higher or lower prepayment penalties. But it's good to know what it is so that you can judge for yourself. It's important, right? Like what you should do with that. Some of them will allow you to pay off your prepayment penalty up front. So maybe they're like, hey, if you pay up front maybe 1 point, we'll waive the prepayment penalty altogether, because you're paying a smaller amount up front for the loss of risk, of having to pay it off. We do have some lenders who will do DSCR loans with no prepayment penalty, but those are only for maybe more exceptionally qualified individuals with the higher credit scores and the lower LTVs. So I hope that's super helpful. One thing that really helps out with this DSCR loan is it allows investors to invest in property without having to qualify based off their income. And a lot of investors will cap out on their income and not be able to keep producing or building their portfolio, right? So, and you don't want to be capped out. Here's a tidbit that I learned recently. A lot of people think that when you buy a home from you get a loan from a lender, they're only going to let you have so many loans at one time because it's risky to let you go too many, right? And that's absolutely the case. Each lender will cap you out. Some lenders will only let you have 10 loans within your portfolio with them. Some lenders will say once you have 20 loans, you can't do any more loans with them, regardless if you have it with them or not, because they think it's too risky. But here's what I learned is that if you want to continue to grow your portfolio for a longer period of time with more and more homes, so let's say you have a goal this year to have 40 homes. You're going to pick up 40 single families. And the lenders are telling you, you know what, you can't do more than 10 with us, or you can't do more than 20 max and stuff like that. That's a problem. And so what I've learned is that with DSCR loans, you don't have to title the home in your name personally. You can actually title the home in the business's name through an LLC. And if you do it that way, the lender, most, will not have a problem with you continuing to build up your portfolio with them with unlimited amounts of properties, as long as you qualify based off of credit, assets, and the DSCR ratio. And so you can just close them in an LLC, and that will be one home, one LLC, or one entity. You can do the other one. Now this year you can do 40 with that one lender. Pretty awesome. Now as a mortgage broker, I have access to lots of different lenders who do this. So we can do them in personal name, we can do them in the company's name, and we can find ways around it. But I hope that's super helpful. DSCR loans are a great source. I can help you work out a personal plan for DSCR loans so that we can put a real good portfolio product placing together for you so you can build your investment empire. I hope you can do that. My name is Jed Barker with Best Life Mortgage. You can contact me at 864-800-9251. You can visit me on any of my social media channels, but I do look forward to working with you and answer any questions you have. Thanks. Have a great day. To your success. Until next time.